It is the year 1900. You are living in the United States. You earn money. You build a business. You buy property. And at the end of the year, the government does not ask you for income tax. Not a single dollar taken from your salary. No IRS forms, no deductions, no tax returns. And yet somehow the government is still running. Military is funded. Roads are being built. And the country is expanding rapidly. So how was that even possible? How did the US government survive without income tax before 1913? The answer reveals something most people never think about. 'Cause the government was still getting paid. Just in very different ways. Welcome to Finance Historian. Before we get started, smash the like button and subscribe if you love educational deep dives. Comment your city and the time you are watching this. I want to see how global this community is. Before 1913, the United States relied heavily on tariffs, taxes on imported goods. This was the backbone of federal revenue for more than a century. If goods entered the country from overseas, they were taxed at the port. And those taxes generated massive income for the government. In fact, at certain points in the 1800s, tariffs made up more than 80% of federal revenue, which means the government was funded not by citizens' income, but by global trade flowing into the country. Every time someone bought imported goods, they were indirectly paying taxes whether they realized it or not. There were also excise taxes. These were taxes on specific goods like alcohol, tobacco, and certain luxury items. If you bought whiskey or cigars, you were contributing to government revenue. These taxes were easier to collect because they targeted production and distribution rather than individual income. During times of war, especially the Civil War, excise taxes became extremely important. They helped fund military operations when the government needed cash quickly. Another major source of revenue was land sales in the 19th century. The United States owned massive amounts of land, especially in the Western territories. The government sold this land to settlers, railroads, and private developers, generating significant income. This was not just economic policy. It was also a strategy to expand the country westward, turning land into revenue while encouraging growth. There were also custom duties and fees, shipping, trade licenses, and various administrative charges. All contributed to federal income. Businesses paid fees to operate. Merchants paid duties at ports. These payments added up across a growing economy. So, in a sense, Americans were still paying taxes. They just weren't paying them directly on their income. Instead, they paid through consumption, through trade, through the cost of goods. The system was less visible, but it was still there. But this model had limitations. As the country industrialized, the economy became more complex. The government needed more money to fund infrastructure, regulation, and national defense. Tariff alone were no longer enough. There was also a political issue. Tariffs disproportionately affected lower-income citizens because they increased the price of goods while wealthy individuals could earn large incomes without being taxed directly. This created pressure for a more balanced system. The turning point came the 16th Amendment in 1913. This amendment gave the federal government the constitutional authority to collect income tax. For the first time, Americans would be taxed directly on what they earn. At first, the rates were relatively low and applied mainly to higher incomes. But over time, the system expanded, especially during World War I and World War II, when government spending increased dramatically. Income tax became the primary source of federal revenue. This shift changed everything. The government was no longer dependent mainly on trade. It now had a direct claim on national income. Revenue became more stable, more predictable, and easier to scale as the economy grew. It also created a new relationship between citizens and the state. For the first time, individuals directly funded the federal government through their earnings. And that relationship has defined modern taxation ever since. So when people say America had no income tax before 1913, it sounds like a completely tax-free system. But the reality is different. The government was always funded. The system just looked different, less direct, less visible, but still very real. And it raises an interesting question. If the government once ran without income tax, could something like that ever happen again? Or has the modern economy become too large, too complex, and too expensive to function without it? And now this is where the story becomes even more interesting. Because removing income tax doesn't just change how the government earns money. It completely changes how power flows through an economy. Imagine going back to a system where the government does not tax your income at all. No direct cut from your salary. No yearly filings, no deductions. Every dollar you earn stays with you, at least on the surface. Sounds like freedom, right? But here's the hidden trade-off. The government would still need money, and if it cannot take it from income, it has to take it from somewhere else. That somewhere else is almost always consumption. Prices go up, goods become more expensive, imported products carry heavy duties, and everyday spending becomes the primary way people fund the system. In other words, you don't see the tax, but you feel it every time you buy something. This is exactly what happened before 1913, but scaled to today's economy, it would look very different. Back then, the United States was a growing industrial nation with fewer obligations, no massive welfare system, no trillion-dollar defense budgets, no global military presence, and a much smaller population. Today, the scale is completely different. The US government spends trillions every single year on health care programs like Medicare, on Social Security, on defense, on infrastructure, for national debt. Removing income tax would create a massive funding gap, and that gap would have to be filled somehow. One option would be dramatically increasing tariffs again. Here's the problem. The global economy today is deeply interconnected. Supply chains stretch across continents. Products are assembled from parts made in multiple countries. If tariffs rise too high, it doesn't just hurt foreign producers, it increases costs domestic companies as well. Prices rise, inflation accelerates, and economic growth slows. Another option would be expanding consumption taxes like a national sales tax. This shifts the burden towards spending rather than earning. But it also raises a serious issue. It tends to hit lower and middle-income individuals harder because they spend a larger portion of their income. The system becomes less progressive and more regressive. Then there is the most controversial path of all, monetary expansion. Instead of raising taxes directly, the government prints money or expands the money supply to fund its spending. On the surface, this feels painless. No taxes, no immediate cost. But the real cost shows up later through inflation. Your money loses purchasing power, prices rise, savings erode over time. It becomes a hidden tax on everyone holding currency. So the idea of a world without income tax sounds simple, but in reality, it is just a shift. Taxes don't disappear. They transform. They move from visible to invisible, from direct to indirect. And this is where things connect to the present. As even today, the system is already evolving. Governments are experimenting with new ways to generate revenue, digital taxation, corporate minimum taxes, transaction-based system. The structure is changing slowly but steadily. At the same time, technology is making income more global. People work remotely, earn across borders, move capital instantly, which is why some economists believe the future of taxation will look very different from the past. Less focused on income, more focused on consumption, assets, and digital flows. So when you look back at a time before 1913, it is not just history. It is a glimpse into an alternative system. A system where the government still functioned, but the burden was distributed differently, less obvious but still unavoidable. And maybe that is the real takeaway. There has never been a system without taxes. Only systems where taxes are easier or harder. And this is where the conversation shifts from history to strategy. Because once you understand that taxes never disappear, they only change form. You start to see the system differently. You stop asking how do I avoid taxes and you start asking where are taxes moving next, because that is where the real advantage is. Look at what is happening right now. Governments around